But what's also been looking good off late is what's happening within the banking pack. And banks are the ones which are somewhat outperforming off late. So let's try and understand what really is going on within the banking pack. You've had exceptionally great numbers come in from ICICI Bank. But does that really change the pecking order within the banking space right now? Vinay Sharma, fund manager at Nippon India Mutual Fund, joins in on the show right now. Vinay, hi, good morning. Good to have you on the show. Let's first talk about ICICI Bank because, that's the latest one to come out with its numbers. It was a beat on all parameters. It managed to even pip Unilever in terms of the market capitalization race, taking the top fifth slot, I think. What is the private banking, what is a private bank like ICICI Bank's performance really telling you about what these corporate-facing banks are set to be poised at in terms of growth going forward?
Yeah, so we can't talk about individual companies here, but we are very vocal past few quarters and actually past few years that corporate banking is the space we really like a lot. India has gone through a big corporate NPL cycle, and if you look at these results, one clear trend that you can decipher out of the initial trends that have come out is that the corporate NPL cycle seems to be well and truly over. And all the results that have come out till date, while there has been some increase in restructuring and some of the retail NPLs have gone up because of the COVID pandemic, but the corporate side has fared really, really well. And if you look at what's really happening on the corporate balance sheets in India, all of the bigger corporates have been deleveraging. BSE 500 debt to equity today is almost 10, 12-year low. And, it seems like we are set for the leveraging cycle now, and the deleveraging cycle, the NPL part of it almost seems to be over. Therefore, we have been very sanguine about corporate banking in India. We continue to like that space a lot. We think this is just the beginning of the corporate leveraging cycle now. The deleveraging part is probably over, and in a few quarters you will start Indian corporates leveraging again. So probably credit growth should also come back a little bit. This quarter result, obviously, credit growth on the corporate side was muted, and only retail and housing and some other parts like SME and agriculture showed growth. But I think that would also change in a few quarters from now. So overall, yeah, it seems like in the banking sector, leadership has moved from the retail banking segment, which was clearly the leader in the 2016 to 19 era, to now corporate banks. And also one big change that has happened, which I think we think everyone has underappreciated, is that the distinction itself between corporate banks and retail banks has narrowed down so much. Between 2016 to 19, practically corporate banking, no bank grew their balance sheet in corporate banking. And therefore, today, if you look at balance sheets of probably the top 4-5 banks in India, almost all of them are between 40% retail to 50%, 50-55% retail. Similarly, 40% corporate to 50-55% corporate. And therefore, the balance sheets have also converged a lot. And the entire distinction between corporate banking and retail banking has faded away. Having said that, we still believe banks who have suffered a lot in the 2016 to 20 NPL cycle will benefit a lot more compared to their retail counterparts in the next few years.
To small banks, whether it is a AU or a Bandhan, or whether it is a old private bank like Federal, or for that matter Cub, do you think they would benefit in this uptick in the corporate cycle, or their relevance and market share will go to larger corporate banks?
So while the overall trend seems to be that larger banks are able to gain market share a little bit more, purely because of the investments in technology that are required today, the technology changes that are happening, the customer franchise, banking is becoming more of a network business today because of technology, and therefore larger banks have that advantage of having a large customer franchise which you can cross-sell to. Having said that, one must remember that a rising tide lifts all the boats, and while one has to be selective and it has to be a little bit more subjective when it comes to smaller banks and the mid-sized bank, we are now starting to believe that it is time to selectively look at some of these small and mid-cap names as well. again, the underlying belief here is that the banking cycle is changing, and therefore next 2-3 years will be good for banking sector as a whole. And so one must look to add a little bit of more risk, more beta when the cycle is going good. And I think that's where mid cap and small cap banks have a role to play. Some of them have suffered a lot in last few years, and some of them have actually changed a lot in last few years. So if you look at some of the mid-sized banks, they have made their balance sheets more granular. Their deposit base has become more granular. They are now more CASA focused versus what they were a few years back. Their retail deposits as percentage of liabilities has gone up sharply over the past few years. So there has been substantial progress in terms of balance sheet improvement, even in some of these mid-sized and small-sized banks. And I think they will benefit. They will reap the benefits of the changes they have made over the past few years in the next cycle if it turns out to be good.
Do you see that in the portfolios you manage, fintech could start making a comeback? I'm not getting into specifics of which fintech you would buy, but since you're managing a banking fund, fintech also comes under the banking fund. And given that's where all the action and all the IPO action will start soon, do you see fintech coming in your portfolios?
Yeah, I guess we had that chat and last time also I talked to you. But if you look at what's happening in the world, clearly there has been a value migration from pure banking entities to some of these fintech entities, whether they're in payment systems, whether they're in internet selling part of it, of financial products. But there has been a value migration from banks and pure lending entities to fintechs, and I think the same would happen over India. The advantage in India that banks and financial entities have is that they've already seen some of that happening across the world, and therefore they have learned their lessons from it. That's what we believe. They will be able to, they have surplus with capital, so if required, they will be able to make a few acquisitions here and there to strengthen their technology portfolio. So overall, while I think there would be some value migrations, and fintech will increasingly play an important role in banking and financial portfolios, and probably in all diversified portfolios as well. However, the value migration that has happened across the world, India might see a limited, addition of it. We will not see the full-scale migration that the world has seen, purely because one, Indian banks and entities are more ready, and secondly, RBI has been more steady in going about opening up the space than other regulators in the world have been.
Hi, good morning. So you've been making this entire point about how the corporate banks are making a comeback. Now we've of course also seen the bank Nifty outperform the Nifty, at least when you look at the last 1 month. The one question I also have for you is, where do you stand when it comes to PSU banks versus the private banks?
So from an overall perspective, we believe there is immense value in PSU banks today. As I said earlier, in the 2016 to 20 cycle, all the corporate-facing banks suffered a lot because of the NPL cycle that happened. And PSU banks, of course, were at the forefront of it because their balance sheets, if we go back in time in 2016, were primarily corporate and housing and agriculture. These are the three segments where PSU banks are traditionally strong at. So therefore, they suffered a lot. And when this cycle reverses, one, there will be a lot of provisioning right back. Their margins will trend up because all the interest reversals that have happened over the past few years will come back to a certain extent. And plus, some of them have actually done a good job, especially the large ones, the top 3-4 ones have done a good job in protecting their market share as well, especially when it comes to the liabilities part of it. And in a rising interest rate environment, this liabilities part of it becomes very important because banks with stronger CASA and stronger retail deposits will have more pricing power, and the margins will look better than entities with wholesale borrowings. And PSU banks are typically all retail borrowings. They are not into wholesale borrowings a lot. Today, they are probably close to zero in wholesale borrowing, but even traditionally, they are not much into wholesale borrowings. So from an overall perspective, and looking at where valuations are today, especially of the market, not of the banking sector, but if you look at where market stacks up today and where PSU banking valuations are, we believe there is immense value in some of the large PSU banks today, and that should play out well as I said, if the banking cycle turns out to be the way we are envisaging it, credit cycle comes back, credit growth improves to double digits in a few quarters from now. In that case, PSU banks will look much better than what they are today.
Raised this entire point about how you must have fintech too, right, in your fund. Now, a few months back, there was this entire fear about how the fintechs are quickly disrupting banks. Um, has that fear ebbed off a lot? As an outsider, as an observer, it's and the commentary we're getting, it seems to be that, or is it a case of the banks that have really upped their game, like ICICI Bank, and look at its digital performance?
Yeah, I guess that fear was emanating more from the global perspective, having seen what has happened across the world. As I said earlier, in developed markets, there has been a lot of value migration from banks to fintechs, especially in areas like payments, internet selling, stuff like that. But if you look at India, one, banks have already seen all that, and they are mentally and behaviorally prepared for it. Second, Indian banks, especially on the private side, are capital flush, and capital is easily available to them at all points of time, unless there is a liquidity crisis or a crisis scenario. Capital is not a problem for Indian private banking sector, and therefore they have the wherewithal to invest in technology, to acquire some technology companies if required. And to that extent, we truly believe that Indian banks and the large financial entities would not be impacted as much as what we have seen in some of the global sector, in some of the global banking systems. And therefore, that fear was a little bit unwarranted right from beginning. That's what our belief is. And to that extent, I think market is now coming to the same conclusion that once the credit cycle reverses and NPL cycle is over, banking will have a decent time going ahead. And even if fintechs come and take away some of the market share, the market is so large, and India is such an underpenetrated country in so many segments and financials that there is probably pie for everyone to eat a little bit. So we truly believe Indian banking system won't be disrupted as much as what we have seen globally. Although having said that, we are not suggesting in any manner that fintechs won't create value. I think there would be substantial value creation from some of the niche business models even in fintech. But probably the pie would increase rather than value migration from one area to another.
Sure. Vinay, great to have you on the show today and getting that insightful discussion going on banks.
Thank you. Thank you for having me here.